Okay, we're live. This is Xenium.Live with all things money, finance, and property. I'm your host, Scotty North, on this Friday lunchtime. And as I say every week, that means the work week is over, except obviously for these two people right here, me and PJ Patterson. PJ, how you going, mate?
I'm doing really well, Scott. You have really raised the bar on the professionalism with this broadcast. I've got to say, with the intro music and everything else, mate, just fantastic, sensational.
Mate, anything that's showing something other than my head will be raising the bar, that's for sure. So we are due for our monthly market update, and compared to last month, it's been pretty active, mate. What do you got for us this month?
Well, there's still plenty to talk about. So let's just give a quick catch up as to where we come from, where we are today, and then, of course, we'll cover maybe where we're going into the future. So we've had the shutdown of the economy. We all know that happened in March, April, May. We've had the reopening of the economy, both in Australia and globally. That happened in sort of June, July, August. And now, for the most part, we're staying open here in September, leading into the back half of this year. And all signs are really positive across a number of metrics. So we're seeing increased activity in manufacturing sector. We're seeing, obviously, people getting back to work, businesses reopening, trading. We're seeing that the coronavirus spread and new cases and all that seem to be reasonably subdued. It was never that big a deal, I don't think, personally, in Australia anyway. But that seems to now, hopefully we're at the back end of that. And really, we're starting to also see, and I mentioned this previously in our last economic update, that China was really firing on all cylinders. China continues to show a lot of expansion. And I actually think, again, that's going to help Australia get itself pulled out of the doldrums because of increased trading activity with China. Increased mineral trading, etc. So I think, broadly speaking, unless we see some reversion back into a coronavirus crisis, that the worst is behind us, and it's steady as she goes, and now hopefully, onwards and upwards from here.
So the talk about a financial or a fiscal cliff, I mean, where does that sit in the scheme of what you're seeing at the moment? Because, what we're seeing on the ground in property land is it's very buoyant, but, we're also approaching next month with JobKeeper rollback and a few other bits and pieces. So what are you seeing?
Well, look, that's a really good question. And I think that remains to be seen exactly how that's going to impact the Australian economy. Obviously, we don't know and won't know until we get there. But I believe that, a lot of workplaces, I should say, have prepared themselves for coming off JobKeeper. Clearly, our government wants to continue to support any businesses that might be struggling. So I think they're just going to take a wait and see approach to that. I'm certainly hearing plenty of anecdotal stories from clients that business conditions have improved, are continuing to improve. And so, again, we'll just have to see when all the stimulus starts to really run off, and that's going to happen in the next couple of months. We'll see what the impact is on the economy. In other words, is it going to be able to stay off of, and not that it was on life support, but is it going to be able to stay off of, constant injections of various capital and other things from the government. Having said that, though, I know you had Terry Ryder on your show yesterday. I think there's still a lot of work that the Australian government's going to do to boost the economy. They certainly don't want us to slip back into recession or stay in recession. So I think they're going to be doing everything they can to support the economy. And I think the biggest benefactor of that is going to be infrastructure spending and that sort of stuff. So, which I'm sure we'll talk about today.
Oh, look, I totally agree. And look, as you mentioned, Terry touched on that yesterday, and it's one of the big things that he really follows with his reports and his forecasting. But I mean, if we thought we've seen infrastructure spending before, I think, what are we going to say? We ain't seen nothing yet, right? I mean, it's going to be huge.
Yeah, it does sound like it is going to be huge. And I've said it a few times on our economic update segments where the Australian balance sheet, so the national balance sheet, is pretty strong. We do not have a very high debt to GDP ratio in Australia. I think it's only about 45%, something like that. Very benign. And so what that means is that the government, through fiscal measures, can certainly continue to deficit spend and borrow money and put that to work in the economy. The key thing, I think, to any of those programs and any of that stuff is to ensure that they go to projects and things where you'll get some immediate benefit, where you'll get people employed, where you'll be paying wages, where you'll be supporting local small businesses and even mid-size and large businesses in Australia. But just making sure that for every dollar of borrowed money that is spent, that hopefully we see a $2, $3, $4, $5 return when it comes to GDP and velocity of money and the other things that go on in the economy when you stimulate in that way. So again, I'm quietly sort of confident that we're past the worst. Australia is looking quite good. There's a few segments in the market in Australia that are looking particularly good, one of which is our technology sector, despite the fact we've had a bit of a sell-off in the NASDAQ over the last week and a bit, and it's looking a little shaky. This is the technology index in the U.S. It is looking a bit shaky, probably because it was a bit overvalued. Australian tech companies, you don't really think about Australia and tech in the same sentence, but we do actually have some fantastic businesses here that look to be in a very good position to power ahead. So we should see that moving forward in our economy. So yeah, as I said, I think the worst may be behind us, and we're off to hopefully the races.
So when you mention Australian tech, I mean, I straight away think of a thong, double plugger, mate, on the feet. I mean, that's pretty high tech. You mean we've got other things other than that sort of thing behind, in our skill set?
Yeah, believe it or not, we actually do have other things in our skill set. You may have heard of this company called Afterpay. I'm not sure if that's ever come up in your family. I certainly have run into a few clients in my mortgage business that have gone on the Afterpay stuff. But that is an Australian company, would you believe? And they are absolutely killing it at the moment. Their stock price has just gone through the moon, and they continue, I think, to go from strength to strength. But we have plenty of other interesting companies as well that are sort of tech-related, realestate.com. For some reason, I'm drawing a blank on some of the others I could quickly check. But anyway, there's a good handful, probably a good 7 to 10 very solid Aussie tech companies listed here that are great businesses that will continue to do well.
Okay, well, that's good. So we're talking during the week, and as we broadcast this, we're around about a little over 5 weeks from the US presidential election for 2020.
Yes,
mate, and I believe the markets are going pretty crazy. What's going on over there? I mean, are the markets just reflecting the state of their nation, or what the heck's happening?
No, in fact, there's a big disconnect between the stock markets in the U.S. and what's going on in the country. So unfortunately, the stock markets, a lot of people will make the argument that stock markets reflect the economy. I don't really think they do. I think what a stock market is a reflection of right at the moment is money printing and the fact that the Federal Reserve is supporting Wall Street and the big firms so that they don't fall over. And of course, the stock market is one of these signs that people use of wealth and prosperity, but it really isn't. Most Main Street people don't have a lot of shareholdings and things of that nature. But circling back to the election, which again, as you just pointed out, it's going to be really interesting. We're, I think, 40 days or something away from the election. And we have two very diametrically opposed candidates. Donald Trump, who's the incumbent, of course, Republican, who is for small government, supporting business, all of those sorts of things. And Joe Biden, the Democrat, who is already telegraphed and been saying that, he wants to roll back corporate tax cuts. He wants to sort of go more towards that socialist slant. I think if Joe Biden gets elected, it's going to be bad for business in America, and it's definitely going to impact the stock market. There's going to be some, and you never really know what a politician will do once they get elected. They may not, it's a big surprise, right? They don't fulfill the promises that they made during their election campaigns. But in any case, he might not go to that extreme if he does get elected. But again, if Donald Trump does get elected, it'll just be more of the same. I think you'll continue to see the stock market doing well. Hopefully, he will be able to get, and it depends too on who takes control of the Senate. That's a big deal. The Senate is currently Republican controlled, but could very well tip over to Democratically controlled. So you might have a lame duck president, for all intents and purposes. If Donald Trump gets elected and he loses control of the Senate, it could very well mean that he gets nothing on his legislative agenda done in the next 4 years, which would be a real shame because America doesn't need that kind of stagnation for that period of time. So it's going to be wait and see. I'm not anywhere close to being a political commentator or analyst, but certainly I pay enough attention to what their economic policies are and the things they're talking about to know that Trump will be good for business and probably good for America from that point of view, and Biden will be bad for business and bad for probably the average person on the street.
Okay, well that's fair enough. It's an interesting take on that. And I think that if we end up with a lame duck president over there, either one of them, well, I mean, if it's Trump, because it won't be the other way around, maybe he can always just push through everything he wants on executive order, right? I mean, that's just what he seems to do.
Why not?
So my question around that was, stock markets are fairly good at predicting some events that are going to happen. There's always talk about things are being priced in already in the market. Is there any indication that the stock market has priced in, the result of the election? Not saying trying to pick who the winner is, but are the markets looking like they're unstable? Or are they looking confident as you get closer to that time?
That's a great question. And the answer is, I think it's still a bit too early to tell. I think, the polls are at the moment saying Biden is ahead and all that. But one of the things we learned in the last election, of course, was Hillary Clinton was ahead in the polls up to election day and then lost by a lot. So, I think that isn't a great indicator. If you wanted to use the stock market, though, as an indicator, one would suggest that it's probably going to be a Trump presidency, because we certainly haven't seen a crash in the stock market since, of course, the COVID crash. It has sold off a little bit here, but that's more of a function of the fact that the U.S. dollar has been very strong in the short term, and there's some correlations between the U.S. dollar and other asset classes. There's an inverse relationship. As the dollar rises, the S&P, the NASDAQ, gold, and a few other things tend to drop. So this would be a short-term thing. I don't think the dollar's rising because it's predicting a Trump presidency. I think it just has to do with some market positioning and so forth. But I think it's too early to tell. I think we'll know a little bit closer. Certainly may even be on election night when this happens. So I remember watching the election unfold during the November election when Trump did get elected. And the initial response by the markets when Trump was elected was a massive sell-off, followed by a huge rally.
Yeah,
so it was just
a
ridiculous day on the stock markets when that all unfolded.
Yeah. So it's all the blue people getting out and the red people coming back in, and the reverse could happen whenever the next time it changes.
Yeah, so, could be.
I look back at. I know you've been out and about and busy today, and I know your chopper was delayed, which is why we were a bit late to start. But I wanted to talk to you about this. Have you seen this come out late last night? You were up. I was probably asleep, mate. It was after 7:30 p.m. But where they're looking to change the rules again on how you get a mortgage. Now, I'm just going to throw it out there and say, been there, done that, got the T-shirt and the scars to prove it. Mate, this looks like it's the same thing over and over again. Have you had a chance to look at this yet or what?
I have, yes. I don't know if I've read this specific article, but there has been some stuff flying around this morning around responsible lending, the fact that that's been completely sort of turfed. And look, this is what I think it boils down to, is the Treasury is basically saying we need to have a robust credit market. So in other words, we need the banks to be lending money to people. And if there are impediments to that vis-a-vis regulation, if there's too much red tape, whereas the banks that is causing the banks and non-bank lenders and so forth to be unable to lend money, then that's a bad thing. So I think what Josh Frydenberg has highlighted here is that some of the regulations that the Rudd government put in place, the Royal Commission, all this stuff has hurt the bank's ability to lend. And so the banks have really gone into a shell, crossing all the T's, dotting all the I's, and doing all this stuff that has, in effect, constricted the flow of credit. Now, of course, you're going to see that turn up in your economy, because if the flow of credit is not happening at a certain rate, or it's restricted in some way, that absolutely impacts your economic activity. And I think the treasurer and even the RBA chair, Mr. Lowe, had pretty much come out and said, look, the issue is not that loans go bad, because the sign actually of a healthy economy is that some loans are going to go bad. That is a function of the business cycle. Some people are going to fall over. It is whose fault is it? You know, so there was this back when Rudd was prime minister and they put that legislation through, there was this idea that it was the bank's fault if a loan went bad, which is just ludicrous, right? You might be a great credit risk today, and something bad could happen to you. You know, you could lose a job, you could have an accident, be unable to work or whatever, and your loan goes bad because of, no one's fault. It's just a no fault, like a no fault accident, right? So this is a really good thing. I think what this is going to do is it's going to grease the wheels of credit a little bit more, which again is going to hopefully impact the economy in 3 to 6 months' time, because there's going to be more access to credit.
Well, that's that point you made there. It's actually the quote I've written down. Now, I've read a few articles on this, and I can't know if it was the treasurer or one of the RBA reps that said it, but it says, on a portfolio basis, we want banks to make some loans that actually go bad, because if a bank never makes a loan that goes bad, it means it's not extending enough credit.
That was Lowe. That was the RBA governor, that
Right.
the RBA chair that said that. Yeah, that's what I was referring to. Absolutely.
Yeah, and that's why I thought that's it's the wording of that is very, very specific, mate. I mean, you can't get any more specific than that. Saying and the whole rhetoric in the articles are all about the pendulum swung too far and this and that, and realistically. I made a joke when the Royal Commission came out, their findings, and it's like, oh, well, the banks won and the brokers lost. But now it's, to me, looking like it's a bit like the property market is buyer beware, borrower beware, rather than, it looks like to me the responsibility is moving from the lender to the borrower to prove that they have provided the right documentation, they've done everything, et cetera, et cetera.
Yeah. I mean, look, that's always going to be there. I think this is just a very explicit recognition that it's okay if a loan goes bad. Obviously there will be questions that will be asked, and if banks are probably experiencing a certain loss rate above probably some norms that are out there, there'll be questions that'll be asked. But I think what this is effectively saying to the lending community in Australia is, you guys can probably relax a little bit now and not be so draconian in the restrictions and the other things that you're doing at the moment to try to protect yourself from a loan going bad. Now, it goes without saying that every single lender is going to approach every loan application from the point of view that they definitely do not want it to go into arrears or into default, or heaven forbid, mortgagee in possession, and they have to take the property over. No lender wants that. But this is just, thankfully, it's a recognition by some pretty powerful people, the treasurer and the RBA governor, saying, hey, we get it, right? That's going to happen. It's a normal part of the credit cycle in business. And I think basically they're saying, it's okay. So, we'll see what the banks do. I don't think the pendulum is going to all of a sudden swing back the other way. And it's going to be, the crazy days back in the early 2000s where you could just have a pulse and basically get a loan. But hopefully it'll unfreeze the markets a little bit and speed things up. Let's just hope that happens.
Well, yeah, and look, I mean, one thing about pendulums, mate, is we always know they swing one way, they swing the other, and they usually go too far. So the next thing I wanted to talk to you about was this one here, where this is back in Australia again. The federal government is looking or proposing, or they actually have changed the insolvency rules to help with this supposed predicted wave of business closures. So it's talking about if you've got debts of under $1 million as a business, that they can remain in control of their company rather than being placed in the hand of an administrator. It sounds similar to me to a bit like what happens in the US, except they've got some other things that are, fairly cool if you're in that situation as well. Not so good if you owe those people if you're owed money by those people. But at the end of the day, it's all about keeping things going, right? So, have you seen anything more about this?
I haven't. I did see that headline this morning. I have not had a chance to really read that article, but again, it looks like what they're trying to do is make sure that businesses aren't wound up, unnecessarily.
Yeah.
The outcome of which will be interesting to see. I mean, most small businesses in Australia would probably be under that $1 million. I don't know if is that an asset base or turnover or something like that, but either way, they would be under $1 million.
Debt's less than $1 million. I
Oh,
think there'd
debts.
be a lot
Okay.
of people with debts less than $1 million. Yeah.
Yeah, for sure, for sure. So I think that would capture, probably, I don't know, I'll just make up a number, I guess, but probably at least 80% of small businesses would not have
Yeah.
debts over $1 million. So I think that really what they're ultimately driving at there is they probably want to give small business a little bit more breathing space to deal with these unprecedented time that we're in right now with this COVID crisis. So I think they're just saying, look, we want to give you some breathing space. Don't abuse it, I suppose. Don't be silly about it. If your business is in the shit, then you probably just need to, face the music. But if there's a glimmer of hope that you might be able to trade through it if you are left alone and not wound up, then that might be better for the economy and better for Australia in the long term.
Yeah, I think that's probably what they're trying to do. So, I mean, there's a lot of changes coming through in a quick time period, and our next market update is in 4 weeks, 2 fortnights time, and I would assume that it's going to be pretty heavily focused on what we've seen that month and coming up to the presidential election. I mean, unfortunately, the US market is so large, and so what's going on there seems to definitely affect what goes on in other markets, including ours. So what do you see the next 30, 60, 90 days playing out? What indicators are you looking at now? What are you doing for your clients?
Excellent question. So as you probably know, and I may have spoken about it on this show before, but I look at global macro as a starting point with three key factors: growth, inflation, and interest rates, and the direction of those three things in all the major economies of the world. And that puts you into what's called a quadrant. So I operate under a 4-quadrant model. Quads 1 and 2 are your growth quad. They're the best quads to be in. Growth is up, inflation is moderate to low, and interest rates are typically not rising, or if they're rising slowly. Quads 3 and 4 bad. 3 is very much a stagflationary environment, which I have mentioned that in the past. And quad 4 is just the shit show quadrant, where everything is in the toilet. It's kind of depressionary. So with that in mind, Australia should be heading into quad 2 in the next quarter or 2 quarters. Then that's a good thing. And that's why I said I think Australia's opportunities going forward are looking really good. I think the worst is behind us. And I think if we get the proper support from the government and we continue to see the Asia Pacific region and emerging markets powering ahead, which we should be seeing, then Australia is going to get pulled along, and we'll get out of this and we'll be back to some really solid economic growth. The U.S. is a bit uncertain. So right now, the strength in the U.S. dollar, which I mentioned earlier, is a little bit of a sign that we are, first of all, the U.S. is in quad 3 at the moment, so it's a stagflationary environment. And but it's looking like with that U.S. dollar strength that they could be tipped into quad 4. Now, again, this is a very bad quad. Not a lot works in quad 4. So what I'm doing right now for my clients is it's actually a bit of a dual mandate, if you will. So we're looking at, for our international exposures, I do have money in the U.S. working in the U.S. dollar. And so I'm holding things like gold, real estate investment trusts, treasury securities, things that are pretty stable and will not have a lot of what's called market beta. So if the market crashes, these things should pretty much do nothing or go up. It's a bit like watching paint dry, but that's a capital preservation sort of technique or tool. In Australia, though, I'm positioning clients in equity. So I'm starting to buy broad market exposure, tech exposure, again, specific to Australia, owning gold and gold miners as well in Australia, because they'll benefit broadly from anything that happens bad, that goes bad in the U.S., because gold will rise. And just broadly setting clients up to see Australia in Quad 2, which is usually very good for stock markets.
So you made a note there on the US dollar. I mean, it was on a bit of a, hang on, we've got to get this right for our viewers, where it was getting weaker against the Australian dollar, or the Australian dollar was getting stronger against it, and now it's sort of gaining strength again as the US dollar. So what's the story on that?
Yeah, the story on that is, okay, this is a very good question, a great topic to explore, because again, if you get the US dollar, the direction of the US dollar right as a money manager or an investor, you're going to pretty much be right on everything else. So the dollar went into a huge bull market during the COVID crash, because again, the whole economy, global economy was crashing. So everybody ran to dollar and dollar denominated assets, specifically really the U.S. Treasury market. Now, as we've come out of COVID and as things have relaxed around the world, et cetera, we've seen the dollar enter now basically a bear market. It is now falling against all major currencies, including Australia. Now, in the last week, we've seen the dollar have a bit of a counter trend bounce. Now, that's just financial planner jargon for saying that it's moved up, but it's had a short-term little bull market, but it's still broadly a bear market. So whilst the US dollar has had a bit of a pop over the last couple of days, the strength of this move has already started to peter out, and we should now see the resumption of the US dollar falling. Now, again, this is going to be good for all your commodity-based investments. It's going to be good for gold. And broadly, it's going to be obviously good for the Australian dollar, because as the US dollar falls, the Australian dollar will rise against it. So I wouldn't be surprised if by maybe early to mid next year, we'll see the Aussie dollar somewhere in the 75 cent, maybe pushing up towards that 80 cent range. We'll have to see. I mean, I don't like making predictions about anything that far out, because anything can happen. But certainly that's the way it would be trending at the moment. So that means that when they do finally open up the borders and we can travel, the good old Aussie battler will be able to buy more, do more shopping when they go to the U.S. to visit.
Yeah, and that's if we've got an airline to fly there on. So the question, and I know I'm talking a lot about the election, and probably even more so next show on this topic, but depending who ends up in the White House, whether it's Biden or Trump,
the other guy,
is that going to severely impact the value of the US dollar to other currencies? I mean, what happens with that? I mean, if Trump's in, is it more of the same, so that trend sort of continues, or if Biden comes in, it's like, oh, this is a new thing, so then it gets stronger, and how does that work?
Good question. It's hard to say for sure, but certainly the Treasury Secretary in the U.S. and the Federal Reserve Chair have, for all intents and purposes, come out and said, we want a lower dollar. So they are trying to get the dollar lower. There's no doubt about it. Now, I don't know why a Democrat would be any different. They might say they want a strong dollar, but the reality is that they do want a weak dollar. And part of the reason for that, of course, is because they want U.S. goods to be cheaper, or exports, that is, to be cheaper, such that you get that more of the GDP being driven by exports. So that's one of the reasons they want a lower dollar. It'll also start to drive some more inflation, which they desperately want. This is the other thing the Reserve Bank in the U.S. is trying to drive, is inflation. They need inflation. Well, they don't need it, but they want it badly. And this is another thing that Jay Powell has indicated. So I don't think it'll matter who gets elected. I think you will continue to see the dollar weakening. And if I could just roll back to the Quad system that I just mentioned, it's really going to be driven by the dynamics of what Quad we're in. So again, if we're in anything but Quad 4 in the U.S., the dollar's going down. That's just the nature of it. If we get somehow back into Quad 4 and stay there for any length of time, the dollar will rise. Now, that is not looking probable. It's looking probable that we'll be in Quad 3 in the U.S. Next quarter, and then the following quarter, and then quite possibly they're going to generate enough inflation and print enough money and start buying enough assets to get us in the U.S. anyway, into Quad 2.
Printing and money and buying assets, mate. It's like their favorite pastime of central banks. All right, well,
The only thing they had left, they really, if you think about it, interest rates are already at zero, so they can't cut rates anymore. So now what do they do?
I was going to ask you about that for Australia. I mean, we kind of run out of time, but I mean, there's only a little bit left that we can go in terms of a drop, right? I mean, our base rate is, what is it? Is it 1.5?
It's 25 basis points at the moment. Yeah, is the RBA cash rate. No, you're absolutely right, and that's the case pretty much for any other a major economy in the world. You look at Japan, you look at the Eurozone, you look at the U.S., Australia, New Zealand. Well, not New Zealand. Their reserve bank's got a higher interest rate, but the point is that all the big central banks of the major global economies already have interest rates at near zero, and this is why the U.S. Fed in the last couple of months has pretty much come out and said, we're just going to start buying equities. So literally, they're now just buying equities. And we all knew that the way they influence the bond market is they buy bonds and sell bonds. That's how they effectively influence interest rates. So they're buying everything. And what will be interesting to see if this continues to unfold is, will they just continue to buy everything to try to influence asset prices? Now, that's a pretty scary place if we really go there. That the central banks are going to be heavy players in the market. That's not the way the market's intended to be set up. It's certainly not the primary mission of a central bank. So we're in some very interesting times around monetary policy, because there's not a lot they can do right now with interest rates because they're already so low. But one thing's for sure, they can continue to print money and they can continue to buy, quote unquote, buy assets. So we haven't really heard the RBA talking about that yet, buying assets. So I think they have pushed a lot of that onto the Australian government to say, okay, we've done our bit. We've lowered interest rates to, near enough to zero. You guys now need to do some stuff. And you know what? The Australian government has responded in spades. They've done a great job, and they're going to do more because they recognize they've got to, as we've already discussed earlier in the show, they've got to continue to support the Australian economy. And luckily, they have the headroom to do it. So, it's just one of those things. We just got to watch and wait and continue to see how it all unfolds.
All right. Well, that's about the best advice we've heard all day, mate. There's not much we can do. We're just watching the market and see how it all unpacks itself. I kind of feel like we know a flood's coming, and you've got all your sandbags ready, and you've run out of sand. It's like, oh well, nothing else we can do. We're just going to wait and see what happens when the flood hits. So. Mate, I think that we're out of time with the interest rates and we're out of time with the show. So, mate, thank you for joining us, PJ. I appreciate your time.
Always a pleasure to be here, Scotty. And I look forward to our next discussion around this. And I think, I don't know if I think we'll be just before the election. So I'm sure all the predictions and all that'll be hottening up. So it'll be a good chat.
Well, that's it. So in 2 weeks' time, we'll have another chat with a topic. We'll dig deep into a topic. And then 4 weeks, as you've alluded to, we'll have our next, it'll be, October market update. Goodness me. So that'll be timely, and we'll have to have our blue and red flags up, mate, and all ready to go. And I think that actually is just before the Queensland state election too. So that's a very interesting week coming up that week for politics in our state anyway. All right, PJ, thanks again for joining us. I really appreciate you coming on. And if you've got any questions for PJ, you want to know how to contact him, you can hit us up on the details that have been scrolling on the bottom of the screen the whole time. You can go to Xenium.Live. You can join our program and get updates all the time. If you go to www.xenium.property/join, or you can hit us up at hello@xenium.property for any questions, comments, or concerns that you might have. That is all from us today. I'm Scotty North, and we're talking all things money, finance, and property, and this is Xenium Live.